and good morning to one second. Good morning to all my colleagues. It's my pleasure to really brief you on this circular and on this area of investment house risk management, which is really one of the area near to my heart. In fact, I being already worked in this area for 1 decade. Definitely, while reading the circular, I really felt that each and every sentence of SEBI circular is more or less what exposure I got on what I had worked upon. So, in fact, being the first person appointed as a risk management position in a mutual fund in India, in fact, in my first job, I was given a task to really make a constitution of this position, make a charter of this position, because in banks risk management, it's a completely different. While for mutual fund risk management, it's a different ball game, because the feeling has been that okay, everything gets passed on to investor, whether it is a gain or loss or hit or whatever it is. So anyway, in fact, after reading this circular, which is a second circular from the earlier circular, which came in 2002, definitely it is very much vast and a lot of things coming into mandatory. So let me brief you upon this circular and broadly as to how you can go about it in complying with the circular. So let me just share my screen first. Yeah, are you able to see the presentation in front of the screen? Mona Lisa, are you able to see the PPT presentation? Hello.
Hello?
Yeah, are you able to see
Yes,
the
sir.
presentation?
Yes, sir. Yes, sir. Yes, sir. Sorry.
Presentation is there, but I don't know why I am unable to move to presentation.
So I can see the PPT.
But I can't see at my end. So let me just stop sharing once again and share it.
Yes, sir.
While sharing, I have to just click this right arrow. Correct.
Yes.
On the share screen. Yeah, after clicking this, my cursor should move to presentation.
So if you just click on that and then go to the right, it will start.
I didn't get. Am I a made presenter?
Yes, sir.
No, I am unable to get it. People can see. But I can't see my own presentation. What I'll do, I'll just, okay, if I put it on cross. Okay, 1 second. Now I can see. Okay, that's fine. Yeah, sorry for the timing. So I hope all of you are able to see my presentation. So first slide. So Mona Lisa, should I continue? You all are
Yes,
able
sir.
to see,
Yes.
right? Okay.
Yes, sir.
Okay, sure. So the initial thing we have been hearing that mutual funds are subject to market risk, but we all realized over the time we all evolved and we now all know that mutual funds are not only subject to market risk, they are subject to also credit risk, liquidity risk, and operational risk. This is the realization fund houses had over the time and even regulator had over the time. I remember the times earlier when credit risk was not at all considered as the risk to investors, because mutual funds were just evolving, it was coming up, and whatever credit risk issues happened, credit defaults or NPAs happened, those were somehow absorbed by the asset management companies only, so preventing its loss pass on to the investors. But over the time, in fact, investors also evolved, and along with the credit risk management system also evolved in the fund houses. At least sensitization increased, and SEBI also along with that came up with various regulations. Of course, SEBI had a much more wider exposure, because SEBI also regulates other agencies like AIF, PMS, credit rating agencies as well. So SEBI's own experiences, like from other credit defaults and NPA issues, governance issues, and circular to credit rating agencies, all that also evolved the thought of SEBI itself to come up with this vast circular. On When I talk about this, one more aspect on the operational risk side, I mean, enterprise, at least the listed fund houses will know that the SEBI came up with the circular LODR, one amendment in LODR in the month of May this year, where it has enhanced and holistically increased the importance of the role of the risk committee, and provided a way as to how the risk committee of the board should look at enterprise-wide risk management with additional responsibilities. Further, these enhancements are applicable to top 1000 listed companies, which basically covers all, I think, all the listed fund houses at least. Mutual funds in a fiduciary capacity, but of course it's different from PMS, AIF, REITs, InvITs, because in those four cases, PMS, AIF, REITs, InvITs, definitely investors are much more aware. They are investing larger chunks of money, and generally the risk prone investors invest in those knowingly the risks. I mean, AIF, I mean, everybody know that, okay, for the money is blocked for 10 years, and return may come from, let's say, 2 3 out of the 10 investments AIF may be making, or something like that. But mutual fund is more of a general product, where any investor throughout the country can invest. Just even 500 rupee investments can lead to buy purchasing of the units. So that's why the regulators are also much more sensitive in this respect. Like any other fiduciary capacity players, funds also carry the risks like governance risk, operational external event risk, and internal external fraud, payment settlement, compliance, reputation, catastrophic. All of these risks are already there. On governance risk side, for example, governance risk is something which is saying that, okay, what is governance? Basically, governance is like fair and equitable treatment with all stakeholders, not just investors, but all the stakeholders, who may be suppliers, who may be customers, who may be board, who may be employees. So it's more relating to fair and equitable treatment. So that way, any kind of governance issue is definitely an issue with the players who work on the fiduciary capacity. And most of these risks, we all are aware that all fund houses equally carry, like any other fiduciary player. On external event risk, which is more like an emerging risk also, like cyber security, digital frauds, recent Taliban case. Now, why this is coming in the picture? This is coming from the perspective of, first, of course, KYC AML, if there are investors coming from those regions. And secondly, from the perspective of investee company, your own investee company, whether in debt or equity, which has larger exposures in Afghanistan area, then recoverability of those funds, and project may get stuck over there. So your investing company may face issues of project risk, receivable related risk, and ultimately higher capital outlay and reduced return, which ultimately impact on the valuation of the company and valuation of your NAV also. Country specific risks are important. If we look back at the incidences happened in, like, Greece crisis in 2012, Venezuela recent crisis, Asian crisis which happened in 1997. Now, we should ideally, as even as a risk manager, we should know the reasons behind these crises, because those reasons gives us early warning signal. Early warning signal are important. Early warning signals are always there, but we tend to ignore, ignorantly we don't look at it, because first of all we are busy in our day-to-day routine, forgetting about what else we need to look at, where should have our radar also. Secondly, once we have list of some early warning signals documented, then it is easier for us to look at the daily news. You need not read each and every news. But once you have your radar open, you may just look at the headlines which comes on the even WhatsApp or other places and see that where you should go into detail, or whether any particular news about Venezuela is reflecting daily basis for next last 10 days. So something fishy is happening in Venezuela. So that way you can really go deep dive into this. Even COVID thing also, there were enough evidences earlier in the month of November December 2019 as to how China is facing troubles and suffering from it, and what it how it is trying to control it. And that's what was giving a clear indication, especially in January 2020, when India had to bring its 600 students from Chinese universities. That was a clear indication that something big is going to happen over here also. So what is this? It is the word risk written in Chinese language. It has two signs. Left side is danger and right side is a opportunity. So definitely every risk throws danger as well as opportunity. And this is where all the entities needs to cope up with the danger and leverage the opportunities, benefit from the opportunities. But the thing is that there are black swans everywhere. I mean, it's not that one black swan has gone, so no second black swan is not going to come. What normally I have seen through my experiences earlier also, that I mean, I think you all are risk managers, so you know the normal curve, normal distribution curve up to 99 99 percentile confidence levels and balance is outlier. Earlier the thought process was is that, oh, it's outlier, let's ignore this. So value at risk calculation or any risk number calculation was only up to 99% and so on. That okay, let's have limit on these and all these things, and outliers let's ignore because that's out of our control. That's what was the thought process earlier. We know a few black swans are out of our control, but most of the black swans are generally man-made black swans. Take the case of Lehman crisis, 9/11, even environmental things. So most of the crises are actually man-made crises. Only a few are there which are not man-made. So of course, black swans are there everywhere, and we have to deal also with the black swans, not just with the normal distribution curve within 99. If you go beyond 99 percentile, we always see that 100th percentile may lie very long deep. It's not within this trend of that curve itself. Generally, the stress events are leading to a loss equivalent to 3 times of value at risk. Value at risk is around 3 times of deviation. Stressed events are further 3 times of value at risks. So this is what it's. I mean, the black swan. The why is this big black swan? The end side of the black swan may be almost 3 times. It means -1, -2, -3. It may go up to -8, -10 times stressed events. So it is always on the minus side, on extreme side. A few stressed event we can see like a negative oil price, which definitely changed the paradigm. In fact, we all have been learning that if you buy a stock, at least it will not go beyond zero. But if you short sell something, the up end is sky is the upper limit of the prices going up. So all these we have been hearing, but over the time we realize that valuations can go negative depending upon the scenarios existing that time and maintenance costs involved. These things were not in the picture earlier, but now all the stock exchanges and markets are aware that yes, this also can happen. Subprime crisis, we all are aware that this is again a stressed event, and such events can happen again and again. Recently also there has been enough comparison of the overall global economic scenario with the scenarios existed in 2006, 7, 8. So I mean, we should not overlook those things and keep a radar on this. What is haunting the BFSI segment in all? It's not just fund houses, but all the whole of the BFSI segment. Mis-selling is the big four risk from the angle of the running of a BFSI. Mis-selling, fraud. Fraud may be governance related fraud, internal or external fraud. Third is anti-money laundering issues. Fourth is outsourcing, which may also include the vendor related fraud or vendor risk management, vendor selection, vendor efficiency monitoring, collusion with the vendors. So these are the four basic aspects haunting all the whole of the BFSI segment. The idea is that it's not giving knowledge on the four. The idea is that when you create your ERM structure, ensure that your risk register, your list of the risk, your early warning signals, everything captures at least these four pointers. Everything must capture at least these four pointers. That is very much important. I'll tell you a real example. Just last month, like Risk Pro is a consultant. It received a lead from one Iranian bank that they want some support on enterprise-wide risk management, anti-money laundering things. Now, the bank I had already heard that bank's name, and Iran is a blacklisted country. I went into the details. I realized that it is a blacklisted bank also and blacklisted country also for anti-money laundering, and they want us to give them anti-money laundering advisory. We had categorically denied it. So it's not that no investor from Iran will come to you ever. So the thing is that always keep your radar open. That is the most important. On operation side, other risk areas also you need to capture, like information security, data security, reputation risk, or a strategy risk. Kodak case, we all are aware about this on the failure of certain strategy and not identifying the change in the overall environment. It faced emerging risks of digitization in cameras and ultimately failed. And insider trading prevention, insider trading risks. On the information security and data security, is privacy are the two different things. Data security, information security relates to our own internal, while data privacy is more relating to global data protection related regulations. This also may become an issue over the time because most of the fund houses and even other entities have a lot of information of investors and as well as their employees as well. So for example, they collect a blood group of employees, health conditions of employee, even health report while joining. All of these are definitely personal private data. So these things will change over the time with the enactment of data privacy regulation here. So now idea is that let us systematically put all the risks and risk management tools together. If we are confused with so many risks around and how to do, like say even this SEBI circular with 45 pages, a lot of things are repeated here and there, and a lot of things are mentioned, sometimes mandatory, sometimes you feel recommendatory, sometimes you feel it is mentioned in the investments topic also, it is mentioned in the operations topic also. So everything is in a mess. That's what you feel. But actually, if you systematically put everything, document, or at least in your in your notepad, if you start putting everything systematically, what is mentioned where, what is mandatory, what is recommendatory, what are the additions to be made in risk policy, what are the pointers for the risk committee, what are the pointers for the risk matrix. So that way, if you start making separate list of each of these and then work upon it by prioritizing a few things, definitely you will have a clear cut mindset as in the right side diagram, and you will be able to deal with all together. You can easily see the left side, once it is mess, it is more occupying more space in the head. But once it is properly clear, then space is free. You save the space of your mental bandwidth. Come to the earlier circular first. First circular on 30th September 2002. That also had a list of mandatory items and recommendatory items, but only three items were mandatory that time. The three items were, as mentioned in the last bullet point. First, it was saying you have either a risk manager or risk committee. It was giving a leeway to have a risk committee also if you don't find a risk manager. Second, it was saying that you have disaster recovery and BCP for three critical functions, which are settlement related, settlement of trade, redemption of the money, and fund accounting. Third, it was saying to have a DNO ENO cover. Now, just for the sake of complying with DNO ENO cover of 5 crores rupees, a few fund houses started taking whatever is available in the market without bothering that how much is the first loss. Even a few global fund houses which has Indian outfit, they were saying that okay, global fund house has already DNO ENO, so we will not take it, without bothering that global fund house has a DNO, but first loss which insured has to bear, this itself exceeds the net worth of local fund house. So it was more or less like a paper based compliance rather than looking at the nitty gritties of whether they are covered by DNO ENO or not covered. 19 years passed, SEBI evolved, fund houses evolved, processes evolved, lot of learning from across all the industries, including from the listed companies also. And SEBI came up with this vast circular having references to lot of areas. First, of course, this also talks about mandatory, recommendatory to list. Secondly, it says that for AMC, you have separate risk management. For each of the scheme, you should have separate risk management uh, framework. When I say each of scheme separate risk management framework, it's more relating to process and documentation, but not the systems and staff and people. The references are made with so many terminologies here, like early warning signal, EWS, KRI, RCSA, ERM, risk matrix, mystery shopping. Mystery shopping was there in an earlier circular also. Now it is coming as a part of the mandatory items. Then now this circular talks about cyber crime, hacking, or virus attack insurance, which was absent last time. It is talking about the scoring approach for credit and liquidity risk management, something similar to riskometer. Riskometer can be a guiding factor, but you can have your own way of creating a credit and liquidity scoring model. Additional measures to review credit and liquidity risk, including cash flow approach, which is more like a in bank that okay, you have bucket wise inflows and outflows estimates depending upon on the inflows. It might depend upon the maturity dates of your debentures bonds, and outflows may depend upon the behavioral pattern of the investors withdrawing their money. So that way you can work out your cash flow approach. It also talks about succession planning, which was now absent, and plus many more things. This last dash keep on adding. Plus many more things are there in this circular. So this circular again, to start with as a basic framework, it talks about appointment of independent chief risk officer. The word independent is added here. Many we had seen earlier that many fund houses had the risk managers reporting to chief operating officer, reporting to chief financial officer, or even chief investment officers. And I mean that's where the basic independence is lost. In fact, it should be the other way, as per this new SEBI circular, that each of the other functional heads should have in their KRA one item of risk management, which ideally risk manager should review. So this circular also talks about appointment of internal auditor only with the background of the risk management. So when an internal auditor is to audit the implementation of this circular, he should have background of risk management. So even if your internal audit has its own audit plan, but for this particular item of audit plan, he may need to have somebody else who can do audit of it, who he may outsource it to some other CA who can do audit of implementation. Then next is a risk management committee for AMC and funds should be there, and if internal audits effectiveness score got recognition this time, because there has been internal audit with scoring with the certain audit score given. And hello, yeah. So now this effective score is getting important because that internal audit effective score can itself be a threshold to judge the risk management score of each of the department. Various policies mentioned in the circular. Now it talks about having documented these policies. Most of these are into mandatory in nature on the last two names. For example, reputation and remuneration policies provided in recommendatory nature, and most others are mandatory. Most of these policies are referred in some or the other earlier circulars also, and most fund houses already might be having many of these policies, but this is the time when they can review these policies and check exactly is it in line with the requirements of this circular also. If circular says that you should mention so and so things also in your policy, is those things, are those things mentioned? Now, for example, in dealing room policy, now we all know that, okay, there should be a voice recording in dealing room. So policy says in two liners, there is a voice recording. But actually, how do you check the voice recording? How many times have you checked the backup of the voice recording? And whether, because every hour, every day, there is a further recording. So whether earlier recordings are wiped out, or if the your tape is full, voice recording closes, it doesn't record anymore. How do you maintain this, whether these things are checked? The policy should have also that aspect, and if not the policy, at least your framework processes should have these aspects. This COI means conflict of interest management framework. This seems to be a new policy for the fund houses, but it is very well there in AIF and many other entities. It says that you should have a framework to handle the conflict of interest. The way you can have the framework, for example, first of all, you can have a separate committee of conflict of interest management. This committee should not have investment team members, and for particular matter to be discussed, it should not have those guys who brought that proposal. Thereafter, that committee should also discuss that, okay, whether there is any kind of conflict that foresee. Before that meeting of that conflict of interest management, necessary declarations from the concerned employee as well as vendor or whoever should be taken, saying that there is no conflict known to us, there is no conflict in relation to this deal. After that also you feel that there is some conflict, then let the committee decide, and accordingly those can be taken care. So it's basically managing the conflict of interest in such a way that conflict piece goes away. For example, allocating the shares purchased across the funds, or in IPO allocations across the funds, there is a good chance that there may not be equitable treatments to some funds. Generally, all the fund houses would like to have a prominent stock in the prominent funds which are in the public eye. So in those scenarios can be drafted by a COI policy, and also have a regular conflict of interest management committee meetings, maybe monthly or quarterly, where these things can be ratified or can be discussed and decided and documented. Stress tests separate policy mentioned, which also a few policies can be a part of risk management policy also, like credit liquidity risk or operational risk policy, stress test policy. All of these can be a part of the risk management policy also. So it's not necessary to have a separate 7 8 10 pager document. Hedging policy is also there, especially to, of course, regulations are crystal clear on many aspects of giving range of hedging you can do, but it is better to have your internal soft hedging limits and guidances as well. Circulars, a few other circulars referred in this circular are that also needs to be complied are, for example, circular of April 2019 relating to cyber security system audit and technology committee, then circular on stress testing 2015, and extending that circular to even debt funds in 2020. When this 2015 circular, I was really, of course, this circular is again can be revamped further, can be improved further from the practical perspective, But of course, it is a step towards the right direction. In 2015 also itself, I was surprised that why it is only for liquid fund. It should have been for all the debt funds, but over the time it is made so. Then September 2020 circular on the overall investment process and like a dealing room related aspects and OMS based trading, cutoff timing, online limit monitoring, soft limit, trade allocations, etc. Additional circulars which you should refer, even though SEBI did not mention, but to get a feel of risk management, what you can add up in your policy and processes, and even to get to know more and for the awareness of on the risk management for other functional departments, it is advisable that you also inform to other functional heads to review these circulars also, like SEBI's guidance to credit rating agency in 2019, RBI circular on liquidity risk management in November 19. Even PFRDA came up with a circular for the investment management of this fund, their fund, from the credit risk perspective. IRDAI circular on risk. Even there is a early warning signal related circular by RBI and SEBI, by RBI to the banks and by SEBI to the stock exchanges, so that stock exchanges can identify early on the default probabilities of the default chances of the stockbrokers. So you can refer to these circulars also where you can get a lot of guidances as well. The idea is that somewhere you have to stop that, okay, without risk there is no return, but you should take calculated risk. The thing is that there has to be a stop at some level where you can protect your capital, you can protect your reputation, you can protect your basic principles of governances. So there has to be a calculated risk you should be able to take. That is an agreed risk, accepted risk, and intended risk. For each of the aspect, it need not be a numerically calculated, it may be a principle based risk limits. For example, there is zero tolerance towards frauds. No one will say that we have a tolerance of up to 3 frauds, tin guna maaf. It's not like that. There is a zero tolerance with the fraud. That's what you can mention in your policies. So it is something has to be agreed, accepted at the board level and documented in your various policy and process frameworks. From the fund industry or any investment houses, the way these four categories of risk are centralized to decentralized. Market risk management, basically volatility and performance risk management, or even for the treasuries part also, or our own proprietary book. The proprietary market risk management is always at the central level in dealing room. Credit risk is much slightly diversified where you may need to really get the rating rationals from credit rating agencies, get the annual financials from the company borrower company, get the references from the brokers around, other lenders around. Liquidity risk is further diversified because your own institutional sales team needs to give a feed on the new monies coming in and monies to going out, your own borrowing limits, and also your own maybe a sort of default letter to the banks that, okay, in case of some disaster happening, because liquidity is something we are part of the BCP, DR BCP, banks are authorized to really redeem the funds. So that way, liquidity risk is more diversified than credit risk. And operational risk, by very nature, we all know, is much more diversified because their operational risk on each and every desk of employees, and each and every employee is a owner of the risk within his own domain area. Risk management committee, the circular on these are the pointers basically insisted by the circular on the risk management committee. Before we go into this circular, SEBI LODR regulation, as I mentioned initially, May 2021 circular amendment on SEBI LODR, you must go through that. Of course, listed fund houses must be knowing because they have to comply, but even unlisted fund houses also should go this, so that they will get to know ultimately what are the intents and how SEBI wants the risk management to be developed. Once unlisted fund house goes to SEBI and tells that we have systems, practices, processes in line with LODR also, definitely it adds to your own governance, reputation, image as well. So the SEBI says that, okay, now in this circular says that there should be separate RMCs for AMC and trustees. For listed companies, board level RMCs are prescribed. Therefore, for unlisted mutual funds also, it is better to have a board level RMC for AMC and board level RMC on trustee side also. At the same time, at the employees level, at the management, day-to-day management level also, there should be a group of employees who can form up an internal risk management committee. It is better to have a board level risk management committee at AMC and trustees, and internal risk management committee, which can be common depending upon and they may look at the agendas on both sides for the board as for the AMC as well as trustees. Committee shall undertake annual review of risk management framework. If you see RMF, framework is not a document. Framework is an overall basket of policies, processes, structure, systems, organization chart, everything what you have. So wherever the risk management framework is mentioned in the circular, it talks about the whole basket. For documented thing, it talks about the policy. Even if at one or two places it says that risk management, it should be documented in risk management framework. Ideally, it means that it should be documented in risk management policy. Once it is documented in policy, it's as good as documenting in the RMF, because framework is a intangible structure all around. It is not a document. RMCs shall report to the board of AMC and trustees respectively and recommend long-term solutions. RMC, these are the sentences coming from the circular. RMC Risk Management Committee should review even passive breaches, corrective actions. Passive breach can be one of the very good early warning signal. Passive breach, up to what level it goes, it's important. Of course, passive breaches are allowed by the regulator. Okay, for example, in equities, 10% per security limit is there, but because of the ballooning prices of one of the stock, 10% to 25% you cannot accept. This is something at the governance, it becomes an issue at the governance level. For example, your own holding says that one of the stock equity stock is 22% because of the price appreciation. It is a passive breach, but none of the other fund houses are having up to 22%. They all are having up to 10, and you are having up to 22%. Somewhere there is a deviation risk also, governance risk also involved. So passive breach are always very good early warning signals, and you should consider it as a part of your early warning signal list. Then it says that the RMC should review the risks and risk matrix and investment policy also once a quarter meeting. It should do independent assessment of reporting to risk to various committees and CEO, like quarterly reporting to committees and monthly to CEOs. So that's what it talks about, risk management committee. If we go into the a little depth on the references mentioned, we will go more in depth in the next few slides also, where for example, when it talks about reputation risk and conduct risk, definitely you should look at the aspects of the kickbacks, fair selling, and sort of mis-selling, mystery shopping pieces also. Mystery shoppings, of course, at Risk Pro also we are doing, but in fact, mystery, it is important that the quality of mystery shoppers should be very good. Otherwise, it doesn't serve your purpose also. Emerging risks, as I mentioned, ESG, cybersecurity, digital, geopolitical, even Taliban is a good example. COVID related, of course, we all generally feel that there is not going to be another wave of COVID, but third wave of COVID or another wave of COVID globally or within the country, all these emerging risks can be considered even though it's not sure that risk is emerging. Internal, external frauds, liquidity, putative liability. This word mentioned in the circular, it talks about uh, more on to what extent your institutional investors really will withdraw. To the extent of your institutional investors, you look at their financials also. If there are overall liquidity crunch with your institutional investors, those investor companies will first withdraw money from you before borrowing from sources of borrowing. So that is very much important to look at the financials and liquidity conditions of your investors as well, because in mutual funds, every day anybody can withdraw money. The other putative liability example is in the closed-ended funds exit dates of exit. So those are also important to look at it. Scheme specific risks are important from the angle of special types of scheme. For example, if you have a global funds, then definitely global country specific risks are coming. If you have a capital protection fund, okay, we all know it is supposed to be capital oriented funds guaranteeing minimum rupees 10 on the date of maturity. It is I had seen in the prospectus initially that none of the fund houses were saying that we are orienting towards rupees 10 redemption on the date of maturity. That on the date of maturity was not at all written by anybody initially. Over the time, of course, fund houses evolved. So these are the things we need to look at. For capital protection fund, what type of debentures you are borrowing? I was talking about scheme specific. Then there can be other types of the funds, for example, value funds. Now, the demarcation between value and growth is you have to be very much clear what your fund house considers value, what your fund house considers growth. Maybe you can have separate list of security universe. Every 3 months or 6 months, your fund managers can look at the security list, because of the confusions around value and growth. Both can be interchangeably used by the fund managers many a times, and it may throw a big style drifts then. Then where was then legal and compliance are the different types of risk. Compliance risk is more SEBI regulator oriented risk, and internal compliance risk like insider trading. Legal risk is the risk of wrong handling of the legal cases, arbitration cases, litigations. Then coming fraud, it talks about fraud risk register and fraud risk scenario analysis also, which is of course a part of the recommendatory item, not mandatory item. But the idea is that the best thing is that a company should have a separate risk register list of risk showing the fraud items. But making separate sometimes is unnecessary duplication. So you may have a single list of the risk, a separate column that with whether this row item of risk is tagged to the fraud or not tagged to the fraud, like that. So that way you can inbuilt in fraud risk register, and by doing data filter, etc., you can pull out the fraud risk register. Fraud risk scenario, this is something which you can identify either by brainstorming or through internal experiences or the expert views. Risk conscious culture, regular training and awareness, just not just one time training and awareness. It should be part of the induction training of HR. It should be a part of quarterly or half yearly training. It can be part of e-learning module also. And also the training of the employee who recently allocated to this job. Estimating financial loss, you should be able to identify the expected financial loss, let's say from coming from reputation risk, expected financial loss coming from cyber security. Of course, no one will be able to identify or estimate it accurately, but there can be some principles, formulas you can use. Very simple example that for let's say for fraud risk, considering the example of PNB, Nirav Modi, how it happened. Now you have to identify that what is the per day withdrawal limit of the fund. If your net banking withdrawal limit of the fund is X rupees, and fraud can be identified in 2 months or depending upon internal audit cycle of that department, you will be able to make some estimate of the financial loss arising out of the misappropriation of fund. So there has to be some way you can identify. There are of course some way you have to identify. You have to just think over depending upon the organization structure, authority metrics, and the limits you have, and try to work around. Potential risk class, it talks about for like it actually this wording is confusing PRC, but ideally what it means is credit risk is one potential risk class, liquidity risk is other potential risk class. So you should consider that way. Risk appetite and risk tolerance is a sort of risk limit principle. Risk matrix and early warning signal, it are the different things it talks. We will come to risk matrix in just 2-3 slides later. So at this stage, in fact, let me take a couple of questions. I think, Mona Lisa, if you can tell me the couple of questions. I mean, I can take up a couple of questions if there are any, and then we can go ahead. Are there any questions?
No, sir. As of now, there are no questions.
Okay, okay. Participants are encouraged to note down their questions. Maybe 5-10 minutes later, I'll again ask and take up the couple of questions. So gap analysis on this slide, the first thing you have to do is the gap analysis with the circular. While doing gap analysis, of course, you need to read each and every sentence, get a confirmation of respective operations department and fund departments to check whether these things are complied with or not. At least it will give the pointers which are in where you are in gap, even though this gap list also may not be 100% correct, but 75-80% correctness you can get, and this itself will guide you as to how to prioritize things and how will you implement it in a phased manner. 1st January, the circular is applicable, but it is recognized in general, I think, that everything cannot be implemented by 1st January, and everything evolves with the passage of time. Even appointment of CRO also very difficult by 1st of January. So the basic what you need to inform to your board and trustees that okay, you have taken so and so and so broad steps which relate to governance structure, and you are going to take so and so steps in next 3 months or 2 months. Then every bi-monthly trustee meeting you keep updating to your board and trustees that that's where we are. Maybe March and half yearly, quarterly, you have to inform to SEBI also that that's where we are. You may do another gap analysis at the end of the March or maybe at the end of Feb to get an idea as to where you are. So that in the month of March you can fulfill the more sensitive items, and then you can put down in your half yearly report. And the other best thing is that I mean, depend you may need to have a time to time conversation guidances from the regulators on this. It's not that you sit idle on the circular with the regulator. You keep talking to regulators, keep updating them that we are here now, we are implementing this. In next 10 days, this should get over, that should get over. That is basically keeping the regulators in confidence. What is risk matrix? Risk registers, many of you must have heard if earlier you had worked with the other type of entity other than mutual funds, maybe if you have worked with the banks or other manufacturing. Risk register is basically noting down the risk, rating of the risk in the high, low, medium, very high, high, low, medium, whatever. Noting down the controls, rating of control, arriving at the net risk, and identifying the high level risk. It also tries to link your head office risks and branches risks. Now, for 20, let's say if you have 30 branches, you cannot have 30 risk registers of 30 branches. A few of the fund houses even have more than 100 branches. Even if they select the top 20 branches, you cannot have 20 risk registers. So risk register also, as a part of risk register, there has to be separate list for AMC and funds, and plus considering the outsourced processes also. What is risk matrix? Let's look at that. Risk matrix referred here is a list of the risks. What you need to have is that you should of course have the list of the risk and separate matrix of it. There should be a clear-cut laid down path of what is your target to achieve and where are you. For example, if you feel that my example is hypothetical, it is not a practically perfect, it may not be practically perfect example. Suppose you feel that your single exposures are very high. Let's say it is going beyond 20-25% of the portfolio, which is a very high risk. So what is the path to reduce it? Your target is to keep it below 8% and arrive at the path that from 20-25%, how will you come to the 8%? Everything may not be sellable immediately, but you know that there are inflows coming in the fund, inflows increasing AUM, percentage of single A may reduce. So from the inflows, from inter-scheme transfers, and from sellability, all the three aspects, you may be able to reduce your single exposures over the time. Maybe a few of these may see a rating enhancement to double A from single A. So all these you need to discuss with your fund managers and sales team as to how the exposure of single A can be reduced from 20% to 8%. So this is how you can make a sort of row level targets. Where are you and the path to be achieved. Similarly, that way for each of the risk, you can make a row level item and you will be able to, of course, this requires some sort of rating because when you feel that single A is 20-25%, somewhere you should rate it as a high or very high. So evaluate risk level with some benchmark. Benchmark may be real benchmark in the outside world, or maybe top rated funds, or maybe the best of the funds, or benchmark maybe even any other PMS portfolios, whatever you feel is the best. Or benchmark maybe your board decided principles. Quantification of risk, as I mentioned earlier, it may be a reflection of riskometer type of scoring. CEO will define risk metrics once it is worked upon by the risk management and internal teams. CEOs has to sign off it so that it gets defined by the CEO. Then other important aspect is that it should be more board approved, part of the board approved policies also, and annual review of the risk matrix by the board, annual report to the board on the key risk matrix through internal assessment of processes which may be done by outside parties. So key risks can be annually reviewed by the board, for which internal assessments can be done either by you or your own employees, or you can outsource to somebody else who will do internal assessment of the key risks. Then CXOs can get do a measurement of the risk matrix even based on the CEI scores of internal audit, like control effectiveness indicator score of internal audit. That also can be a part of your risk matrix. That if CEI is at a lower level, you target to achieve it a higher number of Y. It is X today, so X to Y. How will you move? How your that particular departmental head will move that department CEI from X to Y. The best thing is, suppose CEI is say 85%, while it should have been 98%. So you should discuss with the internal auditor that 98 to 85, where does it has it reduced? Just target on those elements, plug those gaps, and in the next audits, you may probably get up to 98 unless you miss out on other controls. KRI, key risk indicators, also can be created with red, yellow, green zone. For example, as I mentioned, single exposure, you can have a zones that exposure beyond 15% red zone, 10 to 15% yellow zone, below 10% green zone. That way you can mention the different colored zone and find out the overall average zone where your in each of the scheme is falling, where your the whole of your AMC is falling. One way also to look at it, the overall likelihood and consequences matrix. For example, the consequences are horizontal, that okay, certain risk may lead to insignificant consequence or more severe consequence, horizontal line. Similarly, certain risk may be more frequent to happen, almost certain to happen. Certain risk may be very rare to happen. Like cyber security is something which may happen on any day. So cyber attacks can happen any day, but misappropriation of fund may be unlikely or rare, or depending upon the overall processes in the fund house. That way you can have a different colored zone, that okay, like these three you can just score as a 1 2 3 4 5 horizon on the vertical line as well as horizontal line. Multiply this, you will get certain score of each of the cell. You may say that anything 20 and above score, if any risk falls in 20 or 25, it is very high risk. If any risk falls in 15, 16, 15, it is also high. And that way, depend, you can give different color. Like if the risk score falls in 1 to 3, it is green. 4 and 5, 4, 5, 6, it is yellow. That way, you can create your own color zone, or maybe by rating names if you don't want to make it color zone. On the same, you can create an appetite line. Appetite line is a diagonal line you create, that you say that all the risk falling below this diagonal line are acceptable, but any risk falling above this line is not acceptable, because it is beyond the appetite of the organization, beyond the appetite line decided by the board and decided by the trustee. So this is what is a diagonal line, appetite line. Logically, you have to define. If you are creating this matrix, you may decide that any score beyond 15, beyond 16 is appetite line. But a few things may be more like a subjective basis. For example, the number of times your systems are down. Your appetite line, you may tolerate 5 hours system down on one of the days in a quarter or one of the days in 6 months. But if it is happening 2 times in 6 months, that is not tolerable. So If your own systems and process feels that okay, at least twice your systems may be down for 5 hours in 6 months, that may be beyond appetite line. You may need to plug those gaps in the operations. The idea is to come down below the appetite line, either horizontally or vertically. Horizontally coming down means reducing the impact. Vertically coming down means reducing the frequency of risk happening. So you have to internally think the processes of the controls which you need to mitigate. For example, reducing impact, one way is to have a hedge or insurances. For reducing frequency, concurrent audit is one of the way. Risk matrix, a few examples here. Okay, before I go, if there are any question, let me take a couple of questions at this level. Monalisa, any
Yes,
question?
sir. Yes,
Yeah,
sir. There are
yeah.
two questions. One is, what does DOP mean?
Delegation of power. Delegation of power is basically it's a authorization matrix only. Authorization matrix, I think you might be knowing. There are three types of authorization matrix. One is who will sign on the expense, who will approve the expenses beyond these levels, approvals of expenses. Second is basically authorized signatory, who will sign the check beyond rupees 10,000, beyond rupees 1 lakh, beyond rupees 5 lakhs. Third authorization matrix will be signatory on an agreement, who will sign on the broker's agreement, who will sign on the office rental agreement, who will sign on outsourcing agreement. This agreement signature is basically through generally either coming through power of attorney, or it is coming through board resolution of authorizing a person to sign on all the documents which are necessary. So that is also giving an authority, delegation of power through board resolution, that is signing the agreement. Second one I told is signing on the check. Signing on the check goes hand in hand along with the net banking password. Here on net banking password, you have to take utmost care, because while doing net banking, password is already given to employee. So through password also there should be adequate checks and balances so that the bank account does not allow pass transfer of the funds beyond that level through net banking. First, I told about authorization matrix by for approval of expenses. For example, approval of say one of the get together of the distributor up to rupees 10 lakhs of expenses can be done by the marketing head. So you can have a matrix that, okay, for these are the left side expenses list, then next column up to rupees 1 lakh, who will approve, then up to rupees 5 lakhs, who will approve, up to rupees 10 lakhs, who will approve, beyond that, who will approve. So actually it is approval of expenses. So that is called authorization matrix, and that itself is a delegation of power. And of course, the internal delegation of power is a sort of like part of the management principles. If you had read in the your MBA or the school colleges that what are the 14 principles of management, one of the principle is delegation of power. That is internally managing your own department. That is something different. Yeah. Any the second question?
Uh, Sir, on the same lines, the same person is asking, but from the circular perspective, what is DOP?
Yeah, it is the same thing, that how you are authorizing your departmental employees, other departmental employees, and at what levels you are clear cut mentioning that who has power to decide on the agreement and approve the expenses, etc. That is important. Approval of expenses is the first thing, because at that level you agree with the other party that okay, we are going to enter into a contract. So that is the first level. Thereafter, contracts are prepared wherever contracts are required to be prepared, or expenses are incurred and expense voucher is given. Then on the voucher approval and check signing or net banking. So the whole process has to be based on authorization matrix or approvals already predefined.
Uh,
Any other question? Otherwise, I'll go ahead.
yes, sir. There is
One
one more
more question
question.
I can take. Yeah.
What will be parameters for rectification index?
Yeah, good question. See, rectification index is basically it is a reference to control effectiveness index only. independent internal auditors, by internal auditors. So basically, just for example, if your CEI is 85% and not 98%, so it indirectly giving a clue that okay, there is a rectification required to the extent of 13%, and you hope that next quarterly internal audit or next half yearly audit it will touch to 95 or 98%. So it's more of a logically representing the same CEI index. Okay, so I'll go ahead. So you can have different parameters based on which you can have your own risk matrix. For example, for market risk or volatility risk, you can have a stress testing based risk model. For example, for debt markets, you can shock your portfolio by 1% interest rate going up, see how much is the hit, and set up certain risk matrix limit on that. For credit risk also, you create a shock saying that assume 20% of portfolio faces a rating downgrade by one notch, so what can be the hit? So that way different type of stress testing and loss on those testing can be your risk matrix. On credit risk side, PD, LGD, diversification levels of your portfolio, liquidity is also maybe cash flow based gaps, like next 30 days are you on the gap or not. Then HQLA is a new term used in last few years. High quality liquid assets it refers to. After Lehman crisis, this word has mainly become prominent. It's basically identifying the assets of your funds or assets your AMC which are highly liquid and can be used in the case of distress for up to 3 to 6 months when there is no other source of the fund. So it might include the unutilized limits also. Then operational risk metrics can be KRI, key risk indicators. As I mentioned that your systems are down twice or thrice in a quarter, in a half year. Style metrics in portfolios, deviations from value to growth, growth to value. What are your broad cutoff or deviation between large cap and mid cap? What are your cutoffs or large cap valuation versus mid cap valuation in your portfolio? How much is a PE multiple differences? All those can be used as a certain risk metrics. Risk matrix and EWS, a few more examples which are more or less on the same line which I told. Number of your inter-scheme transfer turnover divided by total turnover. All of these shows the intensity of inter-scheme transfer used in managing the funds. Early warning signals, others like in your investee company, in your debt funds or corporate debt funds or other normal income type of funds, whether your investing company has a higher debt leverage, increased debt leverage, reduction in DSCR. These things may happen even before the credit rating downgrades. This is very important. You should have a quarterly review of your debt fund investee companies because credit rating downgrades may happen over 6 months, but over 3 months before that only, you will be able to visualize that something fishy is happening. So before downgrade happen, you may look into this, or probably market is smart enough and the market yield may go up. So all those can be used as early warning signals. You can do some research on this or guidances internally from your research team, investment team, or from outside experts. It may be by us or any other outside experts through which you can take guidances on setting thresholds. For liquidity risk, your EWS can be based on the cash flow loan to deposit ratio if you are investing in a bank, or NSFR is a net stable funding ratio mentioned by RBI for the banking liquidity risk management. So that are you all able to hear me? Mona Lisa, are you able to hear me?
Yes, sir.
Okay, I don't know. I
Yes, sir.
received it.
Clearly.
Okay. So this is something, at least you go through that. What is NSFR, which RBI has mentioned for the bank's liquidity risk management. You will get a clue as to what extent you can use or whether you can use this. Current ratio is always the most prominent early warning signal of short-term liquidity crisis. You will agree that liquidity crisis is liquidity default or default even by companies like ILFS. Defaults happen due to short-term liquidity crisis. It doesn't happen due to long-term liquidity crisis. In long-term liquidity crisis, at least there is a time available to arrange for the funds or to sell off the assets. But Short-term liquidity crisis is the most prominent for any kind of default happening, and that's where even the recent case happened in like Evergrande in China. All of these are the real examples of short-term liquidity crisis. For market turmoils, you should be able to have your EWS by pairing, as I told, that pairing of the large cap, mid cap, deciding the equilibrium of the difference, like gold to silver ratio. Many people work out the whether gold will go up or silver will go down or what will happen. So they work out the gold to silver ratio type of pairing. The circular talks about the three lines of defense. Basically, first line of defense is definitely each of the risk honor. You should have the policy framework and the process frameworks based on this. First line of defense of operational risk management, each of the risk honor. Second line, the independent risk management and compliance officer. And third line of defense is all internal auditor. If there is a cross connection among them, then the line of defense gets weak. For example, if risk manager is reporting to CEO, second line of defense is reporting to first line of defense, or is reporting to CIO, then second line of defense doesn't work. Even the head of internal audit, if he is reporting to head of risk, or if he is reporting to chief operating officer, that also weakens the position of head of internal auditor. So these three should be a separate three baskets of independent reporting. There is no fourth line of dependence. See, a few companies who had been blamed for non-governance, they were raising a point that at least statutory auditor should have told that there was a fraud. We were not aware, but statutory auditors should have told. But no, statutory auditor can never be fourth line of defense. That's why better to make your three lines of defense stronger. Statutory auditors are appointed by shareholders, not by the board or management. So your risk contents of your risk management policy, just a snapshot, which more or less I had covered in various other slides, but put together over here. Here, more the things which I did not talk about is in your operational risk management policy, you should have framework of incident reporting. Near incident reporting, basically loss reporting, operational loss reporting. Take for example, your very simple example. If your petty cash box remained unlocked in the evening, next day morning your cashier identifies that, oh, it was unlocked, but there was no theft. It was a near miss, but still he should report this to the risk manager that this was a operational risk the organization faced, which could have led to so much of the loss. Care should be taken that these should not lead to the appraisal factor of those employees, otherwise this reporting will not happen. So all that required a lot of good governances and awareness of the same to all the employees. Root cause analysis. If there is really a case, you should also do root cause analysis, that exactly what happened, why it was missed out, why certain manual error or certain Excel based error happened. It might be due to I mean multiple files opened by the employees due to 10 works done at the same level of the timelines or whatever. Doing a root cause analysis is very much important. NPAP referred in this policy in this your circular new product and process approval. It is a processes you should have, that whenever you come up with a new type of fund or new processes, new system installed, or maybe certain major change in the commission structure to the brokers, or anything which is major in nature affecting more than 2-3 departments, you should have internal meeting of those stakeholders along with the risk management and do a risk register of it. Unless you do risk register, you will not be able to identify that. You will definitely miss out some of the risk. 100% sure you will miss out some type of risk. I'll give you one clear cut example. In one of the case, one of the fund house, they were about to come up with a fund, about to change the scheme structure in such a way that the fund will always have a 50% nifty short sell. 50% of portfolio will always be hedged by a monthly rollover of the futures. But because of this, through risk register, they could identify that it will lead to additional cost burden because rollover cost, brokerage cost on both the side, plus jobbing difference on both the sides. All of these will add to further cost, which will lead to about 1.25% per annum loss in the scheme performance. Now, this fact was required to be informed in their PPM, in their disclosure documents. So ultimately, they decided to do away with this because 1.5% loss in the performance is too much comparing to peer groups. It talks about the human error and root cause analysis. The circular also focuses on the human error with, it's not like blaming a human and really affecting his appraisal. It's identifying the operational errors. Operational errors may happen due to system, people, process. So identifying where what went wrong, that's more important. Gray Reno, what is Gray Reno? Gray Reno is actually knowing the risk is there but ignoring that risk. And a simple example, current environment factor, global warming factor is a perfect gray reno case where all the organization know, real estate industry also know, but I mean, everywhere deforestation and complete wastage disposal into the river, air, everything going on. The other example of gray reno is a housing crisis and led to Lehman crisis. Lehman crisis was in 2008. Before that, there was a bubble, housing bubble in 2006-7, and first housing crisis happened in 2007. That itself was enough early warning signal. All such gray renos are actually early warning signal. So we should really look at that very much carefully and try to work out our own early warning signal for AMC business, for fund management, keeping in mind all the risk areas, whether it is a governance, credit risk, liquidity risk, or anything like that. Sorry. Early warning signal related some circulars you may refer to. Sorry. SEBI and RBI circulars, as I had already mentioned. Third number, stress testing to arrive at early warning signal. You should keep doing stress testings based on certain scenarios so that you will get to know about what can go wrong where. For example, stress testing of certain issuer going down by two notches. It may lead to default of the principal plus market rate yield hit. You will realize that, okay, market interest rate will shoot up for two rating downgrade. Triple A, double A, we all see, but we know no one bother that even A minus rating has such a higher yield. So that's what you will be able to know once you have a stress testing. And you can do early find out early warning signals of internal and external frauds by looking at HR records of employees, admin records of employees, outside bank background verification of even vendors also, and fraud events happening in the peer group companies. One of the very good examples I will tell you that in one of the company, employee was going to the office trip and using the company's guest house and the office car over there, chauffeur car, guest house. Over the time, the guest housekeeper complained that this guy is misusing the guest house. He's just misusing the chauffeur car and car also for his personal purposes. Based on his complaint, it was realized that today he's misusing guest house, tomorrow he will misuse the funds also. So that employees was asked to leave the company. So there are different ways where you can use the experiences, try to get in observations of guest housekeeper, very simple example, or wherever he goes, even the receptionist at that other branches, that will also give you a very good clue about what time the employee is coming or going, etc. Stress testing scenario, there are circulars we all know, but stress testing scenario analysis are now mandatory. Scenario analysis is more on the operational aspect, while stress testing is more numerical. Stress scenario analysis, for example, you can do as if you assume that suppose your office building collapses or there is a fire. So how will you cope up with that? Once by doing brainstorming, you will realize that your company will incur so and so expenses. You need to have so and so preparedness. Your own business continuity plan and mock drills should also be based on the different scenario. Take simple example. the whatever mock drill you do for business continuity or fire drill you do, you always assume, you do not assume, you completely ignore that your server is not shut down properly. In the real time situation, your servers gets abruptly closed. In case of fire, the fire brigade guys will throw you out of office, keeping your servers on. After half an hour, 1 hour, server will abruptly shut down. In that scenario, whether from disaster place, backup place, your IT guys will be open to the same servers which closed abruptly. That's what should be the real mock drill, and that's what will give you an idea that in the real fire situation, are you able to switch on the servers which are closed unsystematically. So it is just one thought and example I'm giving you, and there are many other gray rhinos which you can look at while doing this scenario analysis. Appetite level, as I mentioned, by diagonal line, you can have such a logical appetite level principles laid down in the policy or in the mission, risk mission statement. You can have some sort of risk mission, risk appetite statements paragraph within the policy or a separate document itself. So that itself will be a sort of complying with appetite level. Appetite level, tolerance levels, both are more or less the same logically. Tolerance level is more numerical, appetite level is more operational in nature. Benchmarking is again the circular refers at many places about the benchmarking. So benchmarking is something which trying to work out some or the other logical benchmark or available benchmark. It's see in the mutual fund industry, generally we feel that oh, benchmark means some nifty Sensex type. It's not like that. Benchmarking means some thresholds, some standards. That's what is benchmarking. It's not always nifty Sensex type. So benchmark your performance with some or the other uh, available or you want to make available as your standard, your ideal. That is your benchmark. It may be a riskometer type of score, your score versus your peer group scores based on the riskometer, or riskometer based on the your score versus your research analyst's ideal portfolio. Something like that you can work out. Benchmark statement in should can be documented as a part of the KRA for performance appraisals. Even internal audit effectiveness score can be a part of benchmark. That your threshold is 98%. That is your benchmark. How far away you are away from this? Why you are away from this? Then benchmark in limits monitoring also, whatever are the regulatory limits, that can be your benchmark, or internal soft limits can also be your benchmark. Benchmark performance of outsourced agency. How can you benchmark performance of outsourced agency? You can work around calculation of ROE or ROC of outside outsourced agency. Suppose you outsource to Carvey Camps or your TA processes, or you outsource to your fund accounting to somebody. Had you not outsourced, how much could have been your investment and how much is your net saving? You work out net saving divided by your net investment. You will work out, you will get the ROCE and ROE from that, and see where, and ensure tell this ROCE ROE to your outsourced agency, and tell that this year we got 5% ROE only, next year it should be more than 10%. Then they will try their best to give you the best of outputs with the less number of employee costs, so that you will ultimately benefit for that from that cost savings. On the investment side also, the circular refers about the risk ratios. Everywhere risk ratios means we tend to feel either beta or Sharpe ratio, but whether this is good enough, tracking error tracking error information ratios are good. So getting a knowledge on this is very much important for your investment risk management team, so that they can guide to the organization as to what they should use and how they should uh, represent this while talking to your distributors or general public, or to investors, or sorry, to fund managers also. Attribution of portfolios across various angles. I'll finding out alpha generated, how much is generated by fund manager, how much generated by analyst. You can try to work out some algo around that. then riskometer based calculations, cash flow approach. Most of these things I have already covered. Concentration, diversification based benchmarking. So that's what is there. Style drift monitoring, I had already mentioned. It's not only concentration diversification of your portfolio, also diversification of your distributor network and investor network. That is also equally important. In investor, you don't just see the compliance with 2025 rules. You have your own soft limits also for investor level diversification. So that's what is more important. The idea ultimately is that you should fasten your seat belt not just to avoid penalty, but to ensure that you do not end up having an injury while running the car. Again, you should fastening seat belt is not enough. You should be proactive enough that you follow traffic rules, lane rules, driving lane rules, so that accident itself do not happen. That's what is more important, and that's what required is proactive monitoring while driving the company. So this is again some list of the schemes if specific points mentioned by the regulator. So that's what is my short webinar, just to give you the highlights as to what circular says.